The next major market crash isn't going to start in stocks. It's already started in the bond market, and most investors aren't even watching yet. I'm Ron Hallaby, your wealth guy. I'm a certified financial planner and pension specialist, and in this video, I'm going to show you exactly what the bond market is screaming right now and why your retirement portfolio is far more exposed than you think. Let's get started. Now, most people think that bonds are boring, the safe stuff. They're wrong. The global bond market is $130 trillion. That's bigger than the entire stock market, and it forms the plumbing under everything. When the bond market sneezes, everything else catches a cold. Mortgages, corporate debts, pension solvencies, and even your GICs. And right now, the bond market is not sneezing. It has a fever. And here's what CNBC isn't going to tell you. Every single market crash in modern history, that's 87, 2000, 2008, and even the UK pension crisis in 2022, all started the same way. Not with stocks crashing, but with the bond market stress first. In 87, the yields spiked from 7% to 10% before Black Monday. In 2000, the yield curve inverted before the Nasdaq lost 80%. In 2008, credit spreads blew out a full year before the Lehman collapse. In 2022, the UK gilts collapsed in 72 hours and almost took out their entire pension system. That's 4 crashes and 4 times that bonds broke first. That's not a coincidence, my friend. That is a pattern. So what's happening today? Well, 1 month ago, markets saw a 1% chance of a rate hike in the US. Well, today, that number has increased to 45%. The 10-year Treasury yield just hit 4.55%, its highest level in a year. CPI in the US came in at 3.8% and PPI at 6%. That's 2 inflation shocks within a week. Meanwhile, you have Jamie Dimon, the CEO of the largest bank in America, just warning about the bond market stress in Oslo. He said that markets are overly optimistic, and he said that stagflation is a very real risk. Well, you have Wall Street partying it up like it's 1999. The S&P is still at all-time highs, and everyone's talking about AI and Nvidia, but nobody is talking about bonds. Well, here's 3 signals I'm watching, and that you should too. Signal number 1, we're going to look at the 10-year yield. If it spikes, not a gradual drift, but a jump, that's a warning. If it happens repeatedly, that's a major concern. Signal number 2 is the yield curve. It inverted every single recession in 50 years. So watch the 2-year versus the 10-year spread. Signal number 3 are the credit spreads. When the spreads blow out, the market is pricing in defaults. That is fear. You don't need a Bloomberg terminal. These numbers are absolutely free. Now, I'm not here to scare you. I am here to prepare you. So there's 3 things. Number 1, check your bond duration. If you're holding long bond funds and rates spike, your safe money can drop 20% easily. Number 2, consider a GIC ladder. Don't lock everything into a single term. Number 3, review your equity to fixed income split. Make sure that your defensive allocation is actually defensive. The bond markets don't lie. They move on real money and real fear. And right now, the signals most people are ignoring are the ones that you should be watching. Now, do you think that I'm being overreactive here, or are markets far too complacent? Subscribe if you want to stay ahead of this story. I'm Ron Hallaby, your wealth guy, and I'll see you at the opening bell.